Okay, all right, Mitesh, thanks for that. Well, Shibani Sirkar Kurian, Senior Executive Vice President and Head Equity Research at Kotak Mahindra EMC, joins us on the show. Hi, Shibani. Happy New Year, and thanks so much for joining us. Looking forward to chatting up with you all through 2023 odd. Well, in terms of the equity markets, how are you feeling? All of us were celebrating 2022 amidst all the volatility, all the headwinds. India stood out. How are you feeling with regard to 2023 odd? A little bit cautious, or are you still constructive?
Hi, good afternoon and a very happy new year to you too. So at this point in time, when you look at equity markets, clearly from a global perspective, there are multiple macro factors which continue to remain at play. And India's growth has been stable and a relative outlier, which has reflected in the way our markets have performed over the last year. So coming to this year, we believe that this is going to be a year where movement of the market is largely going to be stock specific in nature, and earnings growth is going to be the key driver, and therefore there is likely to be fair amount of dispersion between sectors as well as stocks. So when you look at a headline level, if you've seen corporate earnings estimates have seen some amount of downtick recently in the first half of the year. But when we look at FY24, we still expect that mid-teen earnings is possible. Valuations is what is somewhat of a concern, both in terms of absolute valuation as well as relative valuations, which is why we believe that in the near term, we will have to contend with some degree of volatility in the market. So the way we are looking at sectors, we are trying to build portfolios based on companies where there is growth and earnings visibility, trading at reasonable valuations. Our preference has been for companies and sectors which have more domestic focus and domestic bias, vis-a-vis global cyclical sectors. So that's how we are really positioned across our portfolios.
Shibani, afternoon, and thanks for joining in, and Happy New Year. Is the domestic theme getting a bit crowded now? Everyone we speak to seems to be inclined towards purchasing the domestic themes and avoiding the global cyclicals. Is it a crowded trade now?
So to that extent, if you look at the way the growth recovery has panned out and why India has been standing out in the global markets has been the fact that growth has been relatively stable where India has been concerned. But within the domestic recovery theme, there are a couple of factors that we now need to look at. One is when you look at the recovery post-COVID, a lot of the recovery was led by the urban segments, which resulted in the growth bounce back. And rural was something that was dragging the overall growth dynamics. At the margin, we do expect that rural growth and demand should largely bottom out. And incrementally, there are signs that there is some degree of improvement on the rural side. And therefore, there are some sectors which are more rural biased, which could be in focus going forward as well. Now, within the domestic theme, there are 2-3 sectors where we continue to see a runway for growth as well as valuation re-rating. One, of course, is financials. We've discussed this in the past where, while the sector has done well, given the fact that, today banks are still trading at valuations which are largely in line with their long-term averages where ROEs are improvement, there seems to be runway for growth there. And the second segment where we continue to remain positive, which is more domestic biased, is the entire industrials, manufacturing and infrastructure theme. So while we have been positive on the domestic story, incrementally we do believe that one, rural demand should start to improve. Secondly, financials and industrials are also segments where we continue to remain positive.
Right. So, Shibani, while you are positive more on domestic facing sectors, would IT feature at any point in your list at some point purely because of the correction that we've seen in the stocks? Is it a value play here at some point?
Yeah, so we have been evaluating IT now pretty closely. Of course, the sector has seen a fairly sharp downtick and correction and has underperformed in the last 6 months. So therefore, from a valuation standpoint, especially where some of the large cap names are concerned, valuations are now reaching back to long-term average trends. Typically with IT as a sector, one key factor that leads to multiple re-rating is the growth and the revenue growth trajectory revival. In the near term, while the overall trend seems to suggest that valuations may have bottomed out, we will still wait to see what is the commentary from management in terms of the deal flow momentum that they see for the next year. And that is something that we will possibly get a sense regarding in this particular quarter numbers. The second factor, when we look at IT is, of course, on the margins front. Margins, we believe, have bottomed out, and incrementally margins should start to improve as some of the pressures regarding attrition, wage hike, etc., is now seemingly in the past. Overall, our view on the sector is that today, given the uncertainty around revenue growth, the large cap players appear to be better placed. And therefore, our portfolio positioning is such that we prefer large cap IT over mid cap at this point in time.
All right. Shubhani, what's your view on consumer durables? Earlier today we spoke to the management of Blue Star, and they said they have not seen any kind of slowdown. But otherwise, various channel checks are suggesting that maybe December was a little bit soft. Your sense on this theme?
Of course, as we were discussing earlier, that when you look at the recovery on the consumption side, a lot of the recovery was led by the urban segments. However, within consumer durables, what we are seeing is in pockets, there is fair degree of competition. Also, while the festive season was very strong, possibly some of that, has started to wane off, and we will watch out clearly for trends in terms of urban demand holding up from here on. Therefore, incrementally, it's important to see that the overall growth on the urban consumption stories remains intact. So far, trends have been fairly stable. But at the margin, if you look at, especially in the last 2 weeks of December, some of the channel checks have suggested that there is some small slowdown that is visible. And therefore, that is a trend that we will have to watch out for. But as of now, it does appear that overall demand and consumption demand continues to hold up. And if you look at the overall consumer durable space, this is a segment that we have been positive on, given the fact that consumer discretionary spend has been leading the recovery. But in pockets therein, also competitive intensity has increased, which means that there is some degree of pressure on margins, despite the fact that you've seen commodity costs actually come off.
By the way, Bharti Airtel has now moved to the high point of the day. So that's showing you a gain of close to about 0.6%. When it comes to Bharti, one of the key triggers the street is going to watch is that whether they will extend that pan-India price hike. In the month of November, the company had taken two price hikes, but but only in two circles. And they said we're testing waters. And recently, what we understand is that the internal thinking in the company's mind is that by February, we'll get an idea of the extent of churn. By churn is because of the higher prices, have they lost a lot of subscribers? If they haven't lost a lot of subscribers, that means the churn is lower.
Yeah.
Then by February, they'll get a clear picture, because sometimes you update or upgrade your plan in 1 month, you repay in 2 months, etc. Right? So by 3 months, you get a picture. So in February, the company will take a call on whether they should extend that price hike to the balance circles. So that's going to be a very important trigger, because once one company does it, usually the competition is going to follow. Shubhani, any thoughts on the telecom industry? It doesn't have too many players to pick and choose from, but do you like it structurally or tactically at the moment?
Yes, as you rightly mentioned, it's a sector which has seen consolidation, so therefore not too many listed players left in the sector. But consolidation has also meant that the sector, in terms of its pricing behavior, has seen improvement in the past a year and a half. We do expect that slow and steady price hikes should start to come through for the sector, which will lead to improvement in terms of profitability. So telecom has been a space where we've been positive on, and we continue to hold that view. As you rightly were discussing, that if there are incremental signs that companies are willing to take price hikes, which should lead to improvement in profitability, that should be the next leg of re-rating for the sector. And so that's something that we will have to wait for.
Shubhani, finally, before we let you go, FMCG has fallen out of favor with everyone given the valuations that it has traded at and the kind of weakness that everyone was seeing in rural demand as well. And then there was inflation. Now, your belief is that rural demand will recover at some point. We've seen, a decent amount of correction in a lot of stocks as well. And the belief is that now the worst of raw material inflation is behind them as well. Will you look at any of the FMCG companies going forward?
Yes, so I would agree here that incrementally when you look at the way the sector has performed, and if you look at the revenue growth trajectory, a lot of the growth over the last year was led by pricing, and volume growth had been muted, and that was reflective of the fact that rural economy in terms of demand was lagging. Now, incrementally, as we start to see signs of some rural recovery coming through, or at least some bottoming out in terms of the demand trajectory, we should start seeing some improvement in terms of volume growth where FMCG is concerned. The second important factor is that, in terms of margins, incrementally raw material costs having come off, margins should also start to improve, and that should aid overall profitability in the sector. And finally, in some specific stocks, you are seeing that the stocks are now trading at valuations which are lower than their long-term average levels, and therefore offer some opportunity. So incrementally, we tend to be a little bit more positive on the FMCG space as well.
Thank you very much, Shibani, for joining in. Need to slip into a very short break. We'll come back with more market talk. Stay tuned.